Well, good morning to you all. Tony Virtue speaking, Virtue and Partners, and great pleasure this morning to introduce you to Dr. Don Hamson, who's the Chief Executive Managing Director of Plato Investment Management, one of the key funds that we use for income from equity, which clearly is pretty fundamental for those of you, particularly those of you retiring or have retired, to get an income stream in all market conditions to put food on the table. So with that as a background, let me introduce Don to you. Welcome, Don, and thanks for joining me this morning.
Thanks for having me, Tony.
Don, you might start by just giving a little bit of your professional background. How did you get started in funds management, and how did you get to where you are today?
I actually have a PhD in finance, and I was lecturing in finance, and actually at the time of franking credits coming in, and one of the papers I wrote was about the importance of franking credits and how certain investors, and now retirees being one of them, would love franking credits. I actually taught Ian McCowan, who's the CEO of Pinnacle Investment Management. He was finishing off a finance degree, a master's in finance, and he was setting up QIC at the time and basically offered me a job, and I moved over to funds management over 30 years ago, and I worked with Ian for about 10 years, and then worked for a couple of other places, and eventually came back to Ian at Plato Investment Management. Was one of the first new boutiques within the Pinnacle group.
Well, it's been obviously a great success story. Perhaps you could explain a little bit about how you run the fund, and particularly clients are very pleased with these monthly distributions. How do you do it? And could you explain a little bit about how the franking works with this?
Our process and our strategy is a little unusual because we very actively trade to get dividends. And the thing about dividends, companies in Australia generally pay just two a year. But you don't actually need to hold the company for the whole year to get the dividends, and we actively trade around dividend events. So we might hold a stock for a couple of months, get its dividend, and then move on. And by doing that between the banks and anything that pays reasonable income, we're able to generate consistently higher income, and particularly franked income, than the market. We obviously have to do things like watch what's called the 45-day rule to make sure we get those franking credits for your clients. But by doing this, we can generate that consistent income and then pay it out monthly as a monthly dividend through PL8 itself. So it is quite unusual. I think most other fund managers adopt buy and hold. But if you think about the client base, retirees, they are in a great situation that they get a full refund of franking credits, which is brilliant, helps increase their income. And they don't pay capital gains tax if they're in the tax exempt mode of retirees in superannuation. So we can trade that portfolio a lot to get that consistent income.
Now, we're just through the interim earnings season at the moment. So with that in mind, and dividend streams and whatever, how did you find the interim season?
Well, it was a bit mixed. There were certainly some big reactions from a few share prices. There were some soft results, I think, from the banks, which saw the banks come back a bit, particularly Bendigo, which is one of the regionals. Interestingly, Commonwealth Bank, which is the biggest company in Australia and arguably one of the most expensive banks in the world, had a very good result. Increased cash earnings by a couple of percent, has excess capital, has very low bad debts, increased divvies by 4%. And then Bank of Queensland came out, and although it won market share, it didn't have the deposit base to actually lend the money out to mortgages, so it had to go into the very costly wholesale market. Its interest margins were crimped. It also had a big IT spend because it's a small bank, whereas Commonwealth Bank's a very big bank. Small banks still have to spend on IT, and they spent more than too much. So that was a bad result for Bendigo, but quite a good result for Commonwealth Bank. If we look around the other areas, resources were a bit soft, particularly the iron ore miners. They all cut their dividends back, but that's because iron ore prices have been weak. Although I think they've got a floor now, so I think we're probably at the end of that. The sweet spot for resources was gold. Evolution increased its dividends by 250%, albeit from a small base. And strangely, we've just run the numbers. If you actually look at all companies that we follow, the average dividend increase was 20%, which sounds really good. But there's a couple of big ones like the Evolution Gold that pushed that number up. In fact, South 32 increased their dividend from a tiny amount to 8 times higher, and so that was a massive increase, but it was still a fairly small dividend. So that skews the number. But if you look at the median company, which is probably the best measure, it actually had a 5% increase in dividends, and dividends usually translate to earnings. So that's not bad. So the average or the median company in Australia is doing okay. But those big iron ore miners, because they are quite big, BHP, Rio and Fortescue, they cut their dividends a fair bit. So the dollar value of dividends was actually down. Other highlights were probably the insurers came through like we expected, but they did talk about it's getting tougher for them because they've been pushing their prices up dramatically and they just can't keep doing that. So it's quite a mixed outlook, but we think things are more promising because we've seen the first interest rate cut. That's good for the economy. And the Commonwealth Bank spending data suggests that people are starting to spend a little more now. They had been cutting back, particularly those people affected by increased mortgages and increased rentals. We haven't seen any mortgage increases for a long time. We've now seen the first cut. So people, I think, are going to start spending more money, which is good for the Australian economy and good for the average company.
Yeah, I think that's about right, Don. Now, just a little bit about outlook over the next next 3 years. Obviously, income is crucial for clients. As we talk about interest rates coming down, that's going to mean that the dividend streams are becoming more and more important. Hopefully, there'll be no change at the regulatory level with franking credits because that is absolutely crucial for retirees. What's your outlook for the next few years for the Australian economy?
Well, we see it as improving because it's called an interest rate cycle for a reason, because it is cyclical. And we had 13 interest rate rises. We've seen the first cut, and they usually follow with a number of other cuts. That will be good for the economy. That will be good for spending and the bulk of companies. I think iron ore prices are going to stabilise where they are, and so the only way they can probably go is up. I don't think they can go down any further. So I'm mildly confident that we're going to have a reasonable next 3 years. I'm not super bullish because share prices have already rallied a fair way, but I think the worst is over in terms of the softness in the economy.
Yeah, I think that's right as well. Couldn't leave this discussion without some thoughts on the US and Trump. It's a minute by minute sort of changing world, and certainly it's if I judge by the emails I'm getting from clients at the moment, it's a very polarizing event, particularly in the context of the US obviously being the largest market in the world. The impact that does have on Australia, tariffs perhaps. Just your thoughts off the bat.
Yeah, I mean, clearly the US leads the world's share markets, so it was very strong last year, and our market rallied off the back of that. I think Trump is very uncertain. You don't know what he's going to do. We saw the blow up with Ukraine and that disastrous interview there a few days ago. Who knows what he's going to do next? But I think this is what's important: to have a diversified portfolio, because if you have one or two stocks that are heavily weighted to US trade and will be affected by those tariffs, that can be costly. So we always run our portfolios quite diversified because, I don't think anybody knows what Trump's next move would be. The reality is there aren't that many companies, Australian companies, that have big exposure in manufacturing and exports to the US, especially via Mexico and Canada. So there's not a huge impact to the Australian market, but I think it's always good policy to be well diversified, whether it's stocks or asset classes.
No, I think that's right too. And anyway, Don, look, we thank you, and the clients thank you for the income stream. I can tell you that they see them coming through monthly, and they can see when you go to the ASX and say for the next 3 months we're going to do this. So hopefully long may that continue. This is Tony Virtue in conversation with Dr. Don Hamson of Plato Investment Management, when experience pays.